I'm Bryce Knorr, Senior Editor of Farm Futures Magazine, and welcome to The Buzz for Friday, August 3rd, 2012. Market analyst Arlan Suderman joins me from Wichita to discuss our latest farmer survey, which showed some surprising, if not dramatic, results. First, a big thanks to the more than 1,800 producers who responded. Your data is giving the market a wake-up call about just how serious the 2012 drought is. For corn, our average yield from the survey came in at just 114 bushels per acre. Harvested acres fell below 84 million due to increased abandonment, as fields are plowed under or cut for silage, almost 5 million less than USDA found in its June 30th acreage report. With crop ratings currently projecting yields between 116 and 121 bushels per acre, our current yield estimate is 117.6 bushels per acre, for a crop of just 9.86 billion bushels, 3.1 billion less than the government projected last month. Over the last 5 years, our August estimate has averaged about 1% less than USDA actually reported. But even with that margin of error, our findings mean the market would have to ration much more demand than currently anticipated. My projected selling range under this scenario doesn't even begin until $9, with potential to $10.80 a bushel. Arlan, you've been talking to USDA officials. Do you think they're ready to get their arms around these kinds of numbers?
Oh, that's an excellent question, and that's certainly going to be a big question going into the crop report next Friday on August 10th. As I've talked to them at USDA NASS, that's who comes up with the production estimate, the statistical division of USDA. And then they're out, have their scouts out in the fields now, doing all the things that we would do to measure ears, to measure ear length, ear girth, weighing the ears, etc., counting number of ears per acre, that type of thing. And so they're doing all the statistical things necessary to come up with a yield estimate. Then they turn that over to USDA WASDE, the supply and demand group, that puts together the balance sheets. And WASDE has the opportunity, shall we say, to use quote-unquote judgment in putting together their balance sheet, although they will use the NASS production estimates. So how low will they go? Normally, I would have expected in the past, under these conditions, for NASS to maybe be somewhat conservative, go down to a yield of 127. Based on what the producers have told us that NASS is likely finding in the field and looking at the crop ratings where they are this week, I think that'll now probably be in the low 120s where USDA NASS will go, because they're still somewhat conservative in making big yield adjustments, and that would be a massive one from the 146 in July and 166 in June. But overall, I think that they will try to be as accurate as they can still through the process. I think they have heard the criticisms and they really want to get this one right. Now, I know I'll get a lot of criticism from people saying, no, NASS doesn't want to get it right. But I think NASS tries to use as good a statistical measurement as they can. Sometimes I would disagree with the interpretation, so to speak, in they're doing their stocks surveys, etc. Maybe not asking the right questions, but as far as actually going out and surveying the fields, I think this is one that they want to get right as best they can. And the crop is mature enough, it should help them get close. But yet I think the farmer still has a better idea than what the surveyors will, and that's why I expect their estimate to come out a little bit higher than what the farmers say.
For soybeans, we estimate a crop of 2.696 billion bushels, 354 million below USDA's July estimates, with yields down to 35.8 bushels per acre. Results from our survey closely matched projections from weekly crop ratings. Farmers told us they planted a few more acres than USDA found in June, offset by higher abandonment, leaving harvested acres unchanged. Our survey suggests rationing will also be needed in soybeans, especially with old crop carryout supplies dwindling after the subpar crops in South America this winter. A selling range of $17.50 to $19 isn't out of the question if demand stays strong. What do you think, Arlan? Will the world run out of soybeans before what looks like a big crop in South America can be harvested in 2013?
Yeah, there's two aspects to that question. First is the big crop in South America, and I expect Argentina soybean area to be up about 5%, in Brazil probably 11 to 12%, maybe as much as 15%. So big increases in soybean area, and El Nino does tend to favor production, although northwestern Brazil will be Brazil's belt will be an area to watch, depending on the strength of the El Nino that we move into over the next few months. But overall, we should see them have a good-sized crop. So can we get to that point? That's the second part of the question, and I think that's a legitimate concern that we will run out. Keep in mind that the South American soybean pipeline is rather large. In other words, it takes a lot of soybeans to keep that pipeline functioning, so there's a lot of beans in the system. You can't draw the stocks down as tight. Also, Argentina, even though the government denies it, there's significant evidence that it is looking at increasing its export tax, which could have implications for producers there. Do we have another strike from producers that brings everything to a halt? Or do they switch away from soybeans? A lot of questions. But the production numbers that we're seeing from producers, from our own yield models, and from what's happening in the field, with the pattern not significantly changed and no evidence that we're going to see significant change over the next 2 to 3 weeks, suggests that we could have a legitimate significant shortage. And thus far, prices have done little, if anything, to actually slow down demand.
A lot of growers we surveyed are interested in using these rallies to sell 2013 and even 2014 crops. Deferred futures are selling for substantial discounts. December 2013 corn is around $6.40 a bushel, while red November beans are around $12.85. Those prices are better than this year's crop insurance guarantees, but are they a good sell in your opinion, Arlan? And how much should farmers be doing at this point?
Fundamentally, I believe that we should see higher prices down the road, probably later this fall, or if not late summer, pulled higher by the closer in contracts, based on when the market finally realizes just how tight this crop is. But from a realistic and a practical standpoint, we have to recognize that we still have significant risk with over $60 billion of outside fund money in these markets. And even though you can have strong fundamentals, if something happens in Europe or in the United States with the economy, with sovereign debt, a myriad of different issues that could happen to create fear, fund managers could jerk that money out and pull the rug out from underneath this market. And then the markets can stay illogical longer than one could stay liquid, is the old phrase. But you could see those opportunities go away. So I have recommended pricing the first 10 to 15% at these prices, but I've been fairly conservative for a couple of reasons. One is I expect we could see higher input costs, and we need to look at that side of the equation. And two, I think that we'll see better pricing opportunities. But keep in mind, run your farm like a business. Look at both production returns that are offered to you, as well as input costs that you have a chance to lock in. Focus on the margin, and then focus on locking in profitable margins.
Thanks, Arlan. Next week we'll find out if USDA agrees with our estimates. Be sure to join us then for another edition of The Buzz.